Okay, great. He can hear us. Good. Nadi, you can catch the first part of the session when I upload it on the YouTube channel, so you can move that. So anyway, so at this point on the daily basis, this is what we're getting to. We're starting to get to that level here, where where things get pretty dramatically cheap, just on a short-term basis. Now, on the shorter term basis, meaning looking at shorter term time frame, as in an hourly chart, let's take a look at that. This is what we're seeing. So on the hourly chart, we are in that territory where we get that quick reversal bounce, just based on past history. I thought this session wasn't getting recorded, but thank God it is, because a lot of people want to hear it. So I just saw that on the other side. So good, that is getting. So you can see that here. When I look at this in a very unjaundiced, like, looking at it like a robot, trying to think like, okay, I know what I'm doing and all that. Just kidding. I think I know what I'm doing. Then things start to fall into place. You can clearly see here that we have a minor gap. And I want to warn people that during heavy volatility, heavy panic, stops getting triggered, things just falling apart, 20, 30 points, stocks down 6, 7, 8, 9 points, percent, all kinds of stuff, big blowouts on companies like LinkedIn, things like that. Do not expect technicals to work like there's some sort of magic. And I do say that as much as I can during my engagement with all of you in the chat room. So just keep in mind that, okay? Because at that point, it's just price and volume and whatever's pushing things down. So let's take a look at the 1800 level. We talked about that earlier. This is what happens at this buffer zone here that we are in right now. I was so exhausted by the end of the day that I didn't realize that the market actually had that quick short covering rally. And I noticed when I reviewed the charts yesterday quickly that there was some huge short covering on the E-minis and a bunch of other big cap name stocks that were getting hit right on the last 30 seconds. Maybe that's where the market to close volume was on the buy side. I believe that's what I heard. I don't give that much credence to that stuff because it's a lot of mechanical ETFs, exchange traded funds, that are adjusting their books at the end of the day. So it's not like the old days where you could actually get a feel of where the market's going to be the following day by looking at buy on close and stuff like that. Okay, I just want you guys to understand that, because there are so many different derivative instruments out there right now, especially the exchange traded funds, which literally trade millions of shares of stock within their baskets, and these algos actually trade those too, believe it or not, that it's not as much of a clear-cut indication of what things will do the following day. Just want you guys to understand that. Anyway, so this is the buffer zone here, and if we break this buffer zone, it's pretty clear to me that if we break the zone here, that we are going to complete this pattern down right here. Okay, so you're talking 1860 down to the 1800. So you're talking about another 60 times 7, around 400 to 450 points that is in the making. Okay? Now, what's happened the last couple of times? And that's what I want to really look at. So every time the markets come down, and this is in my opinion, this is the trading zone that we are trading in on a short-term basis on the 1 hour charts. This zone here, 1950 to 1870 or so, 1870, 1880. Give or take 5-10 points. You got to give that for small slippage. This part is something that the market did back in what Wednesday was this? This was 3 weeks ago. Okay, when we hit the 1800 level, and it was just like a free fall. You could see that, and that was a fantastic trading opportunity to get up there. But once you get up there, the market basically just simply moved within this range. Actually moved within the range of 1880 to 1910. This range, as you can see here, and it only got to that 1950 level on just once, and that was on Tuesday, right? This past Tuesday. So anyway, so what I'm getting at, that this is pretty clear. It's like, kindergarten drawing. We are moving within a range of 1870 to 1950 or 1940 or 1870 to 1920 if you want to be more on the conservative, side. So 50 points here, 50 S&P points multiplied by 6 or 7, you're looking at 300 to 350 points max. We break this very quickly, stay fully short all the way down to 1800, because any bounce of this level, there is nothing here in my opinion to allow for a mid-level bounce back towards here. It has to, once we break the 1860 level hard and stay below that, give it an hour or two to see. You know how things move fast, right? It breaks and then does what it needs to do. So don't get fooled in. We're in the business of making money, regardless of our cognitive bias, whether bullish, bearish, whether the world's ending, not ending, that type of stuff. I'm just trying to give you some very neutral views on what I'm seeing. So don't get too heavily short if it stays here and then starts to run up, because I've been there and I don't like it when I've been very heavily short because of, got all excited and this and that, and then the market just rips me, goes up 100, 200 points for no other reason other than the fact that the machines came in to kill the shorts. And it did that in the past, I believe, 10 minutes of trading or 20 minutes of trading on Friday when the market, I believe, was down. Well, I was calling for 300 down. We almost went 300 down. I did those quick lotto puts, which went from 1 to 3 fast within like literally 10 minutes. And then the market basically rallied up, short covering rally to about 100 points. Means nothing. That was just the end of the day adjustment short covering rally. Don't look into it like, oh, it's everything's over. So saying all that, so that's basically what it is. Now, if you look at the internals, it's pretty clear that every time we get down to these levels, we get deep, deep oversold. Once you get deep oversold, you always have the inevitable bounce. It's simple. Why? Because people who shorted up here, for example, or shorted here, or even shorted here, they can see their P&Ls and feel fantastic that they're up that much. But unless they covered their shorts, i.e. buy back the shares, they're not going to monetize that money. It's all about monetization, not about looking at the P&L. I've seen my P&L sometimes looking fantastic, and I did something stupid by holding on too much longer, and it's deep and it's back in the red big time, right? It's happened to all of you guys too. So unless I monetize it, what I'm seeing green on the screen on my profit and loss statement, and I monetize it by selling that or covering the put and or the short, whatever the case may be, I do not make money. Is that clear to everyone? Is that clear to everyone? I mean, this is a very simple concept, right? We all know that. You guys are traders. You guys both know that. I mean, all of you know that. So if you're short and you're looking fantastic in your P&L, you're up a bunch of money, and you don't capitalize on it by covering the short, which simply means you're buying back the shares. If you're short a stock or a company, then it means nothing. So like I say, these algos are designed to snatch money both from longs and shorts. Just the way it is. Just the way it is, okay? So that's what I'm saying here. A definitive break below the 1860 level, and we can start to see these lines keep on turning down instead of turning up. If we slip below, let me try to clean the screen and show this, because I've seen this happen and I've acted on it many times. Let's say we slip below 1860. It's like a whoopee. Now remember, there was a big move up. We slipped below that level there too, and around 1850. And then all of a sudden, you get this massive reversal candle. So what I'm getting at is we are in deep oversold territory right now. I would love to have a significant amount of my trading capital completely short and just go away and just say, hey, it's going to be, it's never like that. At least for me. Maybe you guys know better. I don't know. It's never like that. I did that a long time ago where I got that complacent on the short side and I just got creamed. Why? Is it just me who's trading the market? No, because if I'm thinking like that as a semi-pro trader, okay, as a pro trader, semi-pro trader, whatever it is, I never look at myself as like somebody who's like a super duper professional, but pretty good at what I do is. And just because you're professional doesn't mean you're good. We know that, right? And how many hedge funds are blowing up right, left, and center, and those guys are real pros. So anyway, the fact is that if I'm thinking like that, it's behavioral game theory, behavioral finance. That means many others are thinking like that. So all of us think and act alike. And the algos see that in the form of stops we have, what we are buying, and all that is displayed and quickly processed in a nanosecond on the supercomputers, and then they move. So sometimes, you hear a lot of times you think like the market's watching you, like, oh man, I do that, it does that. Well, it's not just you. It's you and 100,000 other clones of you who think the same way. That's the reason why you think the market's watching you. So the eyes of the market are on you, and 100,000 of you guys or 10,000 of us who are doing the same thing. And that's the reason why the market does what it does. And when I say what the market does, it means what the machines do. And that's something you got to clear that in your head. People don't seem to understand that. No one gives a hoot if we have 20 contracts of something right, left, and center, right? It's with the fact that many others are thinking alike and doing the same. So that right now the bearish sentiment is significantly high. We know that. There's a level of panic in the air. You can't open up one media without seeing like the doom and gloom scenario. So obviously a significant amount of people are thinking that. Nobody's bullish right now. That's a fact. Okay. Even I'm not bullish. So there you go. Yes, I have some tactical longs here and there, but I'm just trying to show what's going on. So here we are. Once you get to that level, it doesn't take rocket science. You get the bounce. Where is the bounce? The inevitable bounce is obviously to that 1910, 1912 level, period. And you can see here that despite all this massive volatility, right? These are large volatility. Anytime the market moves like this, that's volatility. I don't need to tell you that, right? Let's say we bounce here. Look at what's happening. Again, I repeat, to the moving averages on the hourly. The moving averages, and again, this is all short term, are still moving pleasantly sideways as if nothing is going on. Yes, there's a minor crossover here, but nothing major is still going on. Pretty incredible to me, to be honest with you. Now, if we look at the longer term charts, we have crossed down. The market is headed down. That's a different story, and we'll look at that in a second. But if you look at the medium, shorter term picture, which includes a bunch of days and stuff, and maybe a week or so, we're still moving sideways and sideways. Very interesting, because it hasn't been long enough for a sustained downtrend to completely take things down the way it should be. That's what moving averages are all about, period. So repeat again, deep oversold, whatever minor bounce comes is going to be capped at this level, in my opinion. If we break above that, we'll take one step at a time. At that point, you might see one of these, capitalize on it, or you get a minor bounce and then a sell-off. Minor bounce means we get halfway on these stochastics, and then you fall. You start the rinse, repeat. It's the same old story. Now, this has happened repeatedly. I'm not making this up. You can see that yourself. And and of course, if we break this level on a sustained basis, then we are going to fall quickly to 1800. This is not going to take days. It's going to take an hour or two. It's going to be very fast, very quick. So at that point, just stay short. Okay. Charts I want to show quickly. My son's got 10 high school seniors coming for their Super Bowl little thing tonight. So so you can imagine. Well, they're good kids, so. Which one did I want to show? I want to show this one. Okay. Once in a while, I show you guys the TradingView charts. Right? And I just want to put things in perspective here. That's my job. And then we'll just take, and then you guys basically process all that information, look at it intraday, what's going on your screens, what I put out there, my comments, and then you decide what you need to do. So when I showed this before, I did have this line put in place from a while ago saying that this is, and there's this arrow here, and there was this arrow there. This arrow was put there weeks ago because this is a formidable resistance level. This level here. Every time we've gone up here, at least in recent weeks, we've failed. And that's the 195 level. Because there's a lot of supply there. And once you take out the 195 level, then you start to see some blue skies on the upper end. So this is a 1 hour chart. Now notice one thing here, that every different platform that you look at, and whatever platform you're using, I've always said, use one that matches mine. so that you can actually put the charts together and actually, see what's going on, and then use whatever platforms you're using as in charting. And I've said that repeatedly. It just makes common sense. If you look to see what's going on here, you start to see patterns. In the middle of the day, when the bullets are flying over the head and we're trying to shuffle in between longs and short and stuff like that, keeping the short trade going, even though the market bumps up like a quick 50 points within seconds, sometimes takes out the short, the S&P puts out, things like that. Believe me, it happens a lot. We don't really get to see the picture. That's why it's important to sit back and review the battle plan, right? On the weekends. So when you look at this here and look at it carefully, one second. Okay. This is like one of those little math riddles, right? Or they show you and they say, hey, what do you think it is? Visual riddles, right? And there's somebody who's very negative. They'll say, hey, I see this. And somebody who sees the glass half full, doesn't think the world's going to end next week, sees a different story. So let me give you both the bearish and bullish scenario, and you guys pick and choose, whichever. In fact, don't pick and choose. Just basically know it. That's all. This is a formidable support level here, right there. That support level breaks, we slip a little bit lower, and then this line comes into play. Now this line from a while ago has been an inverted head and shoulder. You have a head here, you have a left shoulder, you have a right shoulder, and then you have this head and shoulder. This is positive. This is the inverted head and shoulder, IHS. I gotta get something that writes better on these screens. It's tough. Okay, IHS, and this is a head and shoulder. The head and shoulder is obviously a negative pattern, and the inverted head and shoulder is a positive pattern. So both are being played out repeatedly at this point. So you got the head here, you got a right shoulder right there, and you got a neckline right here where we are. That's why I keep on saying that we're at that critical juncture, that if we slip through and really punch through the 1860 level, 1850 level hard, we are going to go to 1800. That's it. So the bottom line is, this is your 1800 level down here, which becomes an inevitable short-term buy as the hardcore shorts cover. Remember, the hardcore shorts don't always cover these bounces. Just the way the hardcore longs on a sustained rally up don't always sell on the way up. They keep on buying more as the market basically dips a little bit, then keeps on going higher. Well, the shorts just do the opposite, obviously. They do the same. In other words, they don't cover every time there's a little bounce. So at this point, this neckline is important. And when you look at this carefully, the bear will say, you know what? It's pretty obvious to me, and I'm talking from the bearish perspective, that the market is going to come and test 1800. The bull will say, hey, this pattern doesn't scare me. Seen this happen a zillion times. Well, not a zillion times. They've seen it happen quite a few times since, for the past couple of months or since the beginning of the year, which is get down to these levels, just feels dramatically scary, and then a bounce. Okay? Because you see that. You're seeing that. Look. So why can't this happen? See the pattern here? The big head. So that's what I'm getting at. And this forms into the 1910 level that I showed you on the other side. So what I'm getting at, the pattern itself is negative in my opinion, because you got the head. So unless you take out this head and shoulder completely above 1950, which I showed on the other chart, then you're looking at somewhere around 1980 and possibly a gap fill up in the 2000 range. But unless that happens, this head and shoulder, this rolling head and shoulder pattern with a neckline of where we are right now stays in place. The neckline breaks, then the lower levels come into play. So that's pretty clear. I mean, there's nothing to it. So to me, I'm just studying the pattern. So this bounce, if we get it, which I think we get, I sell. So you got to be very tactical. That's where tactical trading comes in. You can't sit there thinking, oh, just because we're having this bounce, we're going to move up and hit 1950 again. Nope. And these things will happen rather quickly. So please be aware of that. Please look at my charts, look at your own screens, and act accordingly. Because there's no way in the world that I can guide people in a fast-moving, volatile market tick by tick. You all know that. And I know you appreciate what I try to do during the day. So saying all that, that's what it is. Now, let's take a look at the internals, which I always look at. And it's the same old story on the hourly side. So this was the little short covering rally that started at these times below, by the way, are different because this is done on Pacific time for some reason. I got to change that thing. That's why it says 6:30. Well, we weren't trading at or set 7:30. That was more like 3:30. How about that? That's 3:30 New York time, and this was 4 o'clock. So just so you know that. Little short covering here. So is it possible that take a little move up? Yeah, and whatever I kept a minor longs in place for a quick dead cat bounce. Take that out rather quickly. Now look at this here on your on the stochastics. They look like I said, every platform they look a little bit different, and this stochastic is looking actually pretty much the same. Deep oversold. Oversold doesn't mean it bounced right away. Oversold can remain oversold. It's possible that the market basically just stays within this range, confuses everyone, either moves up or breaks down. We don't know yet. So again, this oversold condition alleviates itself, and if we get a real big rally, then we're going to get up there and do about 200-300 points. Or if we get a minor rally, we're going to go halfway here, right there on this blue line. And this is all preset, so you don't need to do anything. If you just put the trading view, you can put this in. It shows up right away, and then you fail again. Now, generally speaking, we get overbought rather quickly because the markets move rather fast, right? So there's nothing to it. Now let's take a little bit of a longer term view on what's going on. Oh, the other platform that I'm going to show you is bear with me. Okay, so here we have the 1 hour again on free stock charts, which is Warden. And this is also pretty clear. It's a little bit more striking because it's got a black background and some lively colors and stuff like that, right? It's more dynamic looking. And if you look at the dynamic here, you can see what's going on with the Bollinger Bands. It's at the lower Bollinger. The lower acceleration band is right here at around 1860. I really wanted this frigging market to go to 1860. The puts, instead of going to 3 and change, would have gone to like 5. But obviously, Mr. Market doesn't always listen to what we want, right? On Friday, I really wanted a meltdown down to that 1860, if not the 1850 level. But they probably waited around for Monday or whatever the case may be. It was a perfect time to do it with the complete breakdown. But the market still didn't do it. I've seen this happen way too many times. Anyway, so here we see here, this is the trading level that we're trading in. On the upper end, we have 19, these are very clear, 1944, 1945, 1950. On the lower end, we are trading in that 1850 to 1860 range. This is your volatility cluster. Breakage of that, see you later, 1800. We should get the inevitable bounce. If the market is completely going to break down, then we will have a minor bounce and a complete fall back down, which would bring us into the 1700s. So that's really what it is. Stochastics are deeply oversold, and you saw that this green candle very visible here as the last minute short covering rally readjustments on the ETF and stuff like that happens at the end of the day on Friday. And you can see the SPY here. This is nice. Okay, so this was the rising wedge that I talked about. We fell below the rising wedge. We tried to re-enter it. We failed re-entry, right here at night at 192, 193, and this is where we are right now. If somebody wants to basically do it this way, and let me show this quickly, is we can do this. We can do all kinds of stuff, This can be called the falling wedge too. Upper end of the falling wedge is around 190. Max move is mean reversion to 190.72. If we break out above that, we test these highs again. At that point, I believe there will be rejection and big selling, which would be the upper Bollinger around 193 or 192.80. So this is very clear. At this point, this was what happened at between 3:30 and 4. You do have deep oversold conditions on the hourly, on the SPY, and this is interesting. A huge spike in short covering of 41.7 million shares. You can see these in Thinkorswim better because they show it on the E-minis. You can see that a huge, and this is easier on the eyes though. 41.1 million shares bought or covered. Right at what time? At literally at 3:59 p.m. Friday. Interesting. So last time this happened was here, which doesn't really tell me much because we were midway on the move up. This is interesting. The last time this happened here was of this size was pretty much right at on the January 20th bottoms. Anyway, the bottom line is the people you can interpret things any way you want. You can say this is the inverted head and shoulder. This is the head. This is the left shoulder. We could come as low as the right shoulder. Here's another right shoulder. Complex head and shoulders. Okay, there are multiple them. As long as we hold these lines, we should be able to bounce. If we break that, then we come down and test the head. The very staunch bulls or dogmatic bulls would say, hey, that's a perfect dragon bullish formation once we fall here, and then we're going to move up here. I say I know nothing, okay? Because the bottom line is I don't know how the markets are going to react if it gets down to that 180 SPY levels. So let's be realistic here. All right, we could break that or we could bounce and create that big dragon bullish formation, which would be the ultimate face ripper rally that nobody expects. That's a possibility. So be prepared for it. There is no inevitability in the markets. I've gone through the crash of 2008. I've gone through the crash of 2002. I've gone through the crash of 2009. I've seen it all. Have I understood it all? Not till years down the road. So I'm sharing with you some many years of experience of what I've seen. Just when it looks like the world's going to end, it just starts to, things start to really move. And at this point, the level of fear and panic and it's pretty high. So whatever the case, some people, I repeat, will say, hey, if we fall 1800, we're going to bounce from here. I say we don't know. So bottom line is that's sort of the slightly longer term. This is the hourly picture on the SPY. Let's take a look at a longer term picture. The longer term picture, if you want to look at it this way, these are the lines. This was the big hammer reversal off the 180 level. Let me take these lines out. Bear with me. Let me go to drawings. Okay, so here you have a longer term picture going back to 2011 when we had the last big move down. And some people say, hey, this is like 2011. I don't believe that. I think this is a little bit more serious because of stuff that's going on. We know that oil, credit markets, emerging market, debt, fear of the Fed remaining on tight with interest rates, things like that. So the two ways to look at it. On this is a weekly basis. Look what's happening underneath the surface. You have a crossover on the stows, similar to what you saw here in 2012, and similar to what you saw here in 2012 primarily, in 2011. Doesn't mean the market can fall further. It simply means that the internals are still crossing over. There's something going on the underbelly. I still believe that this level of 180 is key. Anything below that, you're starting to, you can basically measure down. I mean, you could come. You need to go further back to see what's going on. So bear with me 1 second. The way I do it is I do the Fibonacci. Let the math do the talking instead of me trying to figure out where it's going or reading somebody else's newsletter to tell me where it's going. So if I do the Fibonacci retracement, okay, on a longer term basis, this is a weekly basis. So be ready for this. On a longer term basis, this is the first level of retracement, 78.6%. Okay, 78.6. So we basically 78.6. This is pretty much where we are right now. So it looks like we are going to come back down and test this level, right? That's fine. That's not something, we can see that on a weekly basis, just to, sort of you can clearly see here, that's where the market wants to go on a weekly basis, right? It wants to go and test. It wants to go and test this. Bear with me. Right here. Like 1800s, all right? 1800s, 180 SPY. Let's keep it at that. Once we break that on a weekly basis, on a weekly swing, the next level of Fibonacci retracement is at 159. 159. So that's roughly what? That's roughly around 1600 S&P. Okay, so that's in the cards. I'm just looking at the Fibonacci retracement. I'm not even doing anything here. And some people say, oh, it's the end of the world. Let me just draw this out for all of you. This was the channel the market was traveling in from 2011 onwards. There were huge drops too, mind you. And I don't subscribe to that theory. We never had a correction. I mean, I've been trading as a pro trader for quite a few years now. Okay, and when I hear on TV, oh, there's never been a real correction, I just feel like throwing up because I've been in the middle of real corrections. I've been years. There've been multiple corrections. So the blatant lie that's always propagated: this is a correction. 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 This is a big fat correction. And what we're going through is a big fat correction. So when they say we haven't had a correction for years, it's just like, I think they're going against the Christian values. I'm just kidding. All right. So bottom line is the bunch of frigging liars, because everyone talks their bias, right? The bears keep on saying there's no real correction. In the meantime, sectors have corrected more than 40%. Two of the major indices, NASDAQ and stuff, is below 10%. It's just numbers they throw around for garbage. I'm just looking at the thing. So what I'm saying is these are two big ones. So when you get two big ones like this, a big one doesn't keep on continuing in one go. That's all I'm saying. I still think we come down here at some point during the year. But what I'm saying is that generally speaking, when you get a thump like this, you get a minor bounce, which at least reverts back to the mean. What does reversion to the mean mean? It doesn't mean we take highs. It simply means we revert back towards the moving averages, which max move is 1960 to 1980. Max move maybe 200. 196 to 198, or maybe 200 on the SPYs, and then a fall again. Because once you break down, once the lines cross over like this, it doesn't take a rocket science to figure out that that's major formidable resistance. Look, the lines cross down here, period. That's it. So we are in a minor downturn, major downturn, whatever you want to call it. All I know is that lines cross down here on a weekly basis. All three of the lines. Three of the major lines, the 34 and the 50. So bottom line is reversion to the mean simply might mean that we just get down, retest the back end of the 34 and the 50 and fail again. I'll tell you, the third time it hits this, it ain't gonna hold. That won't be the third time. It'll be 1, 2, 3. We've already done the third time. 4. Fourth time it hits that 180 level, it's gonna be boop. Down. Seriously, that's just the way it is, because the floor gets weaker. That's what's going on, right? Now, if somebody thinks that immediately right now, starting Monday, we're going to completely give away and break below 180 and see 174 on that, I don't know. Maybe it happens. I just think that we get a quick, based purely on technicals, okay? That we get a quick 100, 200 points, that type of stuff after opening down on Monday, move up a bit, like just like I showed on the other ones, and then we give in. So we'll see what happens. Let's take a look at the E-minis, the futures. This is the futures chart on the hourly. We can see here pretty deep. Yeah, I would say this is something interesting, and I've showed this before, and I've made money off this. You all know that. It's called positive divergence. There's a minor positive divergence going on despite the real smash down on Friday on the indices. The last time we were at this level here on the NASDAQ, which was around this level, right? You can see that very clear. That was Wednesday. On Wednesday, we were down here on the McClellan oscillator. We were at minus 600. We went down to the same level, and the McClellan oscillator is at minus 310. What does it tell me? Not a heck of a lot. It simply says that despite this massive selling pressure, the internals did not succumb to the same lows of Wednesday. That's all it's telling me on a short-term basis. In simple English, we get a short-term minor bounce, which I have said and explained and given you the exact numbers on the previous charts, and you got to sell that. That's it. That is a positive divergence. Nothing to get too excited about. It simply means that we should have been down at minus 600 given the same level that we came down to on the markets. We should have done that. Didn't do it. Does that mean that deep, underneath the surface, there was some short covering, there was some smart money buying? I don't know, but that's generally what I see. Let's do this 1 second. Remember, the machines are also like humans in the sense that their behavioral patterns don't change either. They keep on doing the same crap over and over again, long and short, right? So the more we understand it, the better off we are. So here we are. This was past Wednesday. Wow, seems like such a long time ago, right? Wednesday. This was Monday. Let's talk about Monday, a week ago. This was the other deep condition Tuesday. We always had some minor, small rallies after that and then gave in. This is more similar to what happened on Wednesday. Okay? Wednesday, we hit really hard. Same level that we hit on Friday on the futures. And bear with me 1 second. Okay, on the futures, here we came down to minus 30. And then on Friday, when we got really hit hard, of course, we were some really beautiful and beautifully ugly meltdowns in a bunch of tech stocks. I don't need to remind anyone. So obviously, we were down to zero on the RSI. So if somebody's playing RSI, these are all functions of derivatives of RSI. I was talking to Jeremy about that one day. So its stochastics are just simply easier to see, and they're a little bit more, in my opinion, reliable. Anyway, so because you see crossovers and all that stuff. So it looks like there's a double bottom here. There's a double bottom. You can see that. Double bottom. And not just a V-shaped move. This was a V-shaped move off this level. So double bottom here, I think, solidifies the position a little bit more reliable from an indicator standpoint. And this dotted line is the VWAP, the volume weighted average price that a lot of institutional traders use, 1885. So you can use that we're going to revert back to the VWAP of 1885. Do the math. 1873, 1885, 12 S&P points. 12 S&P points is roughly about 72 to 80, 72 to 90 Dow points. I'm not failed there. So whatever, you get a nice little fat bounce on the opening or whatever the case may be. Don't sit around. If you have some longs, take the profits. And of course, you got to watch the internals to see what's going on. The other thing that I look at, without boring people too much, is the McClellan oscillator. Oh, I just already showed that. 1 second. Let's take a look on the daily on the thing. Look what happened. I also watched the volume candles big time People ask me, what do I see during the day? I see a lot of stuff, but these are things that I think will be very helpful to a lot of people. There's a lot of services out there who never tell you what they are, how they're analyzing the market, why they're saying what they're saying. I try to keep it as transparent as possible. I think that's a good thing, transparency, so that my members know what I'm looking at and just making up funny stories. So looking at this here, look what happened here. This is at 3 o'clock, and this is at 4 o'clock, well, into the close. So basically, since 3 o'clock, and you saw that reversal candle right here, it correlated with that big reversal. There were 308,000 contracts of E-minis covered or bought. The big selling was right here at 10 o'clock, because by 10 o'clock, these institutional margin clerks and the funds, which basically a couple of them blew up, that's a fact, with concentrated LinkedIn positions, concentrated Amazon positions, concentrated data positions. Obviously, the margin clerks are not going to say, oh, we'll see you Monday, come up with the money. They're just going to chop, 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 chop. You don't see 40% fallouts on stocks for fun. It didn't even happen during the crash of 2000, where stocks just fell 40% in one day. It happened in some of them, but not like, you're talking about two name brand companies losing 40% plus of their value in one given day. It's almost laughable, to be honest with you. But that's just the way machines work. As I've said it before, and I say it again, algorithmic high-frequency trading programs will amplify and magnitude every single move in the market and in individual stocks. I've been in the business long enough to know you do not lose 40 to 30 to 40, 50% of the value of a name brand, multi-billion dollar company. Not talking about a company worth 100 million in one single day, unless you get a massive technical blowout. End of story. So this is what happens. So I watched the E-minis very carefully. Does it give me a little read? Yeah, kind of. It does. Doesn't mean that it's, it doesn't tell me exactly what's going to happen at the open, but it gives me a read as to what some of the so-called machine-driven money, not smart money, machine-driven money was doing at the end of the day. Now, let's take a look at the daily. Another thing I want to point out, which you guys might have heard in the news quite a bit, or maybe not. I did post some articles on this. Very important. A lot of significant hedge funds, sovereign wealth funds, the Saudis, the Norwegian ones, the big fat ones, which are more oil dependent, let's put it that way, are actually playing E-mini futures in the US and Globex futures across the world after hours to come up with money. That is one of the bases for the massive pump and dump that we see in the US markets. You get 100, 200 point open, and within seconds they turn around and it keeps, and drops 50 points, 100 points, and then goes down another minus 200. Ladies and gentlemen, this is not US fund managers who are doing this. US fund managers, believe it or not, are not the worst gamblers in the world. These sovereign wealth funds are in deep crap, which itself is not good. But in order to meet their liquidation calls, they are creating intense volatility by playing, I repeat and listen carefully, they are playing these big cap stocks. They're liquidating some of these portfolios which are hitting the big cap stocks hard, because the big cap stocks, every share of Priceline that you're selling, you're making it's $1,000. You're selling 10 million shares of Priceline. Well, do the math. It's going to be what, $1 billion worth of market value lost, or $100 million. So that money is being used towards paying down their institutional margin calls. Believe me, they have a lot of margin too. These sovereign wealth funds are not invested just in cash. It's cash leveraged to buy other stuff. So let me put this in simple English for some of you who are not understanding what I'm saying. These guys are playing Globex, that's global overnight futures. Primarily the S&P futures, which dominate the Globex market, in order to make to basically pump things up and then sell immediately, take the money, and then put it towards their institutional and large global margin calls that they're paying. In other words, they're using E-mini futures as a currency, and that's where a lot of the pump and dump stuff is going on. I don't want to get into it too much, but It is a fact, in my opinion, that that's what's going on. So saying all that, let's take a look at this chart that I've shown quite a few times. It's exact pattern symmetry. There's no question in my mind on that. Okay, this is where we are. I've explained that now thoroughly. This is the level of interest, not just a level of support, but a level of intense interest to all of us. And if we break that, we got 1848 as a Bollinger, because, you know, that's nice. We are getting a pinched Bollinger in the form of how pinched this is. Let me show you that. This is all the wacky stuff I watch, and a lot of it worked very well. And you know what? I'm going to keep doing what's worked. This, ladies and gentlemen, is a pinched Bollinger. Look at the size of this bottleneck. It's getting tighter and tighter. A big move down brings us to 1800, quite likely. Retest. I've already explained what might happen after that. If you want to follow the lower acceleration channel, you're looking at 1774. This one actually shows it nicely on the E-mini. 1774 on the E-minis. That's about 1780 on the S&P 500. This is the level of interest we're going through as a support level. Bollinger's getting very pinched. If we get down here, it's a possibility that we make another move to the upper end of the Bollinger, which again falls in with the numbers I've shown you before, which is around that 1940 level and 1950 level on the S&P 500. And that's where we are. Now, this is a daily chart. So here's the interesting point that I see. Oh, when I talk about pattern symmetry, you guys should, by now, many of you are starting to see it. This, ladies and gentlemen, is a rising wedge. This, ladies and gentlemen, is a falling wedge. We came out of the falling wedge. Did I get super excited? Oh, yeah, that's it. We're going now. I said, no, be careful. I did put, and some of you who are starting to really track my charts, and you should be, and use your own stuff too. You're very smart people, so you got to start looking at your own things too. I call this that this is a bear flag. I'm sure all of you remembered that. I said, is this a bear flag? Well, if this is a bear channel, because that's what happens, a short covering bear. You want to know what exactly a bear flag is or a bear channel, then look it up. If this is a bear channel, we got to the upper end of the channel, and it did perfectly what it's supposed to do, fall out of the channel. Fall out of the channel. Then we tried to re-enter the channel. Failed again on the downtrend line. I simply drew this red line as a downtrend line. There. I drew this as a downtrend line. Guess what we did? We hit the downtrend line exactly to the T. And then we fell again. Big, fat, ugly candle. But then this was a big, fat, green, bullish candle too. So it's all pattern symmetry in play. This, ladies and gentlemen, is the volatility cluster that you're looking at. There's nothing new in the picture. I don't want to harp on it too much, but this is what we're doing. We're trading within a band here. So people say, oh, we're going to have a big break one with the other. Not really. We're just going to be trading in a band, and then we'll have some breaks. How about that? A big break down here will be 1800. A big break up here would be 1984, upper end of the channel. However, the bear flag, in my opinion, is still intact. I want to be very clear about that. The bear flag is intact, and the bear flag is this channel, this magenta line right here is a bear flag. We're not even entered it yet. We did enter it a couple of times, so even if we enter it, we got a bunch of supply points or resistances in the form of the Bollinger 34-day moving average. Upper end of the bear flag is 1975. If we clear this out, then you can say that this level, this move here, will come into play. In other words, we're going to go back and test 2090. That's it. It's really as simple as that. Now, how it manifests itself during the day in a turbulent market is a different story. But this is exactly what the machines are predetermined to do, which is come, retest 1800, or make a move up, enter this channel, I repeat. And when I post this, now you'll fully understand what I'm talking about. It's entered this channel, and once it enters the channel, you start to see short covering. So over 1925 or so, let's say, you start to see short covering. which will move the market fast and furious up. Don't wait around thinking, oh, I'll buy it when they buy some, make that money, and leave it. Don't have to wait till the market gets to the upper end of the channel. It's worked great for me. I'm not waiting around for some nirvana like, that, oh, the market's going to go off 400 points before I sell. If I suggest a trade and it's up 3 or 4 points, what are you waiting around for? Take it. Then do whatever you need to do with it. Short it, buy some puts on the S&P. That's the way I play the short side. There are traders in there who do extremely well, like JP and stuff, who shorting individual stocks, and congratulations on that. And you know what? It's all fine and good. So you got to just skin the cat the way you want, So that's the way it goes. At this point, this channel here, I'm going to draw one more thing. I'm going to wrap some of these drawings up. Okay. Watch this. There. Okay. You can do it like this. I'm going to touch this point. Yeah. Okay. So somebody might say, and believe me, I've done this long enough and I've actual proof to show multiple times that I've been correct on this too. Some guys who are saying, hey man, that's a little bit too much panic that happened. This is what I think is going on. We started to move up in a channel. Now we created a consolidation channel. You can see that. And then we're going to break out of the consolidation channel and move up towards these levels of 1975 and 1950. Well, can happen. Because so far, the way the lines are drawn, we are still in a consolidation channel. We can slip below it, absolutely. Futures will probably come down to 18. This is actual futures, right? So the futures might actually show 30, 25 down when in about an hour, 2 hours, when the market, the Globex trading opens. Okay? And we test this lower Bollinger. Like just the way we slipped down here below the channel. But look what happened after that. We moved up. Whatever the case, if we start to see a reversal of this 1848 level on the E-minis, then beware of doing some big massive shorts immediately as the market opens. Just letting you know, because the same thing happened. The same thing happened on the 3rd. Broke down, big reversal candle, and then we got towards the upper end of this consolidation channel, 1922, and we gave in. So at this point, we could hold this level, or we could come down and test 1849 in the Globex markets, overnight markets on the E-minis, and then make a reversal candle off the lower open tomorrow, and then move up to its upper end of the range. So I still think this is formidable resistance trying to enter this channel, because channel entry is key. Channel entry means entering over this, this channel, because once it enters the channel, there's a good possibility they're going to just technically squeeze the market up towards 1950, 1975 for no other reason other than the fact that there's a significant amount of shorts that need to be hit. So bottom line is that it's all tactical, and in this type of market, don't rely on anything. It's very violent out there. Nothing good or bad. I'm just telling you, in the sense that by the time you think it's okay to buy something, it's not okay. It's time to sell. So these type of technical levels that I'm showing, that I post repeatedly, I think are key. Look at this channel here on the hourly. This is more pronounced. Look at that. It's a Darvas box, which I use methodically. We are at the lower end of the Darvas box. You can see that. Let me see. Pointer. Okay. Lower end of the Darvas box. Bear with me, sorry. Let me use the little hand, okay? Right there. Lower end of the Darvas box. We are bouncing. We could bounce to VWAP 1885. Best case scenario, we get to the upper end of this large downward sloping consolidation channel. The keyword is downward to 1911, and we sell off hard again. Otherwise, we break this level here at 1863. This is not S&P. This is E-minis, all right? You got to track it on your screens. Then the next level of interest comes at 1850, which was the lows of 2 Tuesdays ago, the 26th. The next level of interest comes here, which was the lows of January 21st, 1836. And then, of course, we have 1804, which was the E-mini lows uh, um, on the 20th of January. So, ladies and gentlemen, what I'm getting at is stay flexible. We'll do our best. Keep trades tight. Swings, in some cases, some of the swing trades are fine. But then I want to warn everyone about something. And please, for God's sakes, listen to this carefully, because this applies to each and every one of you. There's a lot of traders say, listen, I'm looking for swing trades. I'm doing swing trades. And the minute the market goes down 300 points, monkey on a hot tin roof, which reminds me, happy year of the monkey, which starts off this weekend, right? The Chinese market is fully closed for the next week. So whoopee. I don't know how to say in Chinese, like jump like a monkey, but the bottom line is that this is so what happens with swing traders are all of a sudden all their methodical thought process, grand thought process, oh, I'm going to hold this swing for the next month or two, go out the window. They're all like monkey on a hot tin roof because the roof got hot, right? And all of a sudden they're all like, oh, what am I going to do? What am I going to do? Well, if you went into a swing trade, then swing it. That's what it means. So I want to make this very clear with everyone that it's like those old days, when I used to manage client money, it was like everyone was a long-term investor, except when the markets basically cracked and went down 200-300 points on a certain day, they're all short-term day traders. They're like, whoa, what's going on? I want to sell. So what happened? I thought you had a 6-month view, Mr. Jones. Well, traders are exactly the same. They all talk about swing and I want to hold this, I want to hold that, and boom, every time something gets a little bit out of whack, they're not watching the charts, they're not following the patterns and everything that my hard work is showing, right or wrong. A lot of them have worked very well. And then they're just like, all of a sudden, they're just freaking out. Well, what can I say? Figure out if you want to be a swing trader, you want to be a part-time day trader to me, it's a combination of everything. I showed you the bearish side, the bullish side of the markets, and that's it. And this is a mechanically driven market, and it's going to do what it needs to do. So decide first, and then it doesn't mean just because you say swing, you can't change your mind. But just don't lose your head. If you're a swing trader, then always have some ability to add to it if things get cheap enough, and within certain technical discipline of being cheap enough to what's right. So that's it. I mean, I just want to remind people, because there's a lot of hypocrisy, garbage, and innuendo that traders like to play with their own minds because they don't know what exactly they want, right? But that's okay. As long as you admit, and I tell my son, okay, and I tell myself, as long as you admit your faults, you know where your deficiencies are, you're going to be a better human being. You're going to be a better trader. And I think all of you know that too. Admit where we are idiotic and then move on from there. Last thing I'll show you is something worth seeing. This is the daily Dow Jones Industrial Average. Watch. And guys, I got to tell you, ladies and gentlemen, okay? There's always learning in there too. The fact that on a Sunday afternoon you're listening to all this stuff does show your commitment, and it helps me too, just so you know that. I'm a straight up guy, to focus on things, because otherwise I don't think I'd be sitting on myself on my own at 3 in the afternoon, Super Bowl day, and talking to myself, right? So this is good. So thank you for being here. 1 second. We're all in this together, and that's all that matters. Just want to show something. Oh, come on. This should be. And some of you who really have an interest in charting and stuff, just play around with charts. It's fun. That's how I learn. No one's forcing you to do this stuff. So again, I want to show you the pattern symmetry again. This was an intensely volatile time, ladies and gentlemen. The crash, the flash crash, the volatility, and then this happened, right? I'm not drawing into the channel. If you look at this without prejudice, sound like a lawyer here, right? Then you can see we're undergoing the same volatility channel, which has not ended yet. So we could be, so like I said, I think the 15,800 level on the Dow does come into play after that minor bounce. And that would be the same level here. There. You can see that here. 16,000. Sorry, 16,000. 16,000. Okay, so 16,000, 15,800 to 16,000 is a good, strong bounce area for the Dow Jones Industrial Average. Just want to show you on the bigger indices. Is it possible that this type of pattern, over the next week or so comes into play and then we do this again? Absolutely. But the channel entry at around 16,968 or so, or 16,900 is a formidable resistance. Entering this channel over 17,000, let me round up the numbers, is something that the market participants will find extremely difficult to do, in my opinion. And if it does do that, it is not going to be a sweet, smooth ride up. It's just going to be one leap up there at 17,500. This channel, downward sloping channel, that the market's been moving in has extreme volatility, roughly 1,000 points. Let's let it know. 1,000 points. So you can sit there and do nothing, or you can try to capitalize on this volatility, which I've clearly explained in the simplest terms. So entering this channel is a far cry, but this pattern symmetry, I repeat, this pattern symmetry here is not that different than what we are seeing here in the form of the volatility clusters. So there's Mr. Magoo for you, all right? How about that? So this is what we're going through. Ladies and gentlemen, I'll end at this. I think it was, I've covered a whole bunch of stuff. And in all fairness, we are entering, you're going to hear a lot of stuff going on, obviously. Oh, one last thing here I have to show. And this is for the Dow, so you can do it like that if you want. Okay, so if you want to look at the Dow within this channel here, let me make it bigger. I mean wider so people can see it. When I do these things, it's not just for fun. It keeps me in perspective of what's going on. And that's where the forecasting stuff comes in. All right. Bottom line is, this is a bear flag, but guess what? It was still within the flag. And this is the daily chart. Once we slip below 15,940 or so, that's when this lower level of Bollinger's come into play. And the lower level of low 15,000 comes into play, similar to the S&P 500. But if you look at this carefully, well, not carefully, I mean, look at it broadly. Doesn't, we are within this channel right now. And there is still a possibility that we get up here and fail. Okay, and unless we break up hard from here, this move up will not happen. And if we break below the 16,000 level, then obviously these lower levels come into play. That's all I got to say. And Nader, thank you, man. I really appreciate that. Nader is a good friend, and he's been with us for a while. And Nader, stop by tomorrow, and we'll do what we need to do. I hope this was educational for you as much as it is for me. We are, after all, students of the market. Let's try to be faster learners. Let's be a little bit more flexible. I'll try to do my best in what I do. Bring in your friends. We have a bunch of very smart people join us lately, and we all want their input. And I think it'll be fantastic. And I read a piece earlier on today that in order for the market to go up, the Panthers got to win. So you know what? Even though I like the Broncos, if that's going to be the case, then go for it. Let's do it. All right. And now I got to go deal with a bunch of very well-behaved teenagers. I hope so. And God bless you all. This will be uploaded on the YouTube channel. And thank you for attending. Take care.